Ladies and gentlemen, Greg Mikulowski from ForexLive.com. I'm going to take a Forex quick look at the New Zealand versus US dollar. Like some of the other currency pairs, the New Zealand versus US dollar is moving sharply to the upside with a lower dollar bias. The US dollar is the weakest of the major currencies, and that is not the exception with the New Zealand versus US dollar. But having said that, the price just moved above the prior closing level. It closed around here, moved to the downside before moving to the upside. So really the gain for the day in the New Zealand versus US dollar is only from about this point right here. The last bit of this move to the upside here for the New Zealand versus US dollar. So it is less bullish, if you will, for the currency versus the dollar in this currency pair. But having said that, what I really like about this, and maybe this is a lesson for you traders, but the 200-day moving average and the 100-hour moving average were converged right here at the low for the day. Both those levels came in around the 0.6150 level at the time. The low price for the day, the official low price for the day, came in at 0.61529. So got within 3 pips of the 200-day moving average, and also the maybe within 5 pips of the rising 100-hour moving average here. So this level right here had a convergence of key technical levels, and indeed the market came down to that level. It was coming down in the Asian session. It was up and down type of move, but we felt support against that level before the market started its move to the upside that we've seen here in the New York session. So that was a nice key level, and maybe a lesson that going forward, if you're looking at currency pairs, pay attention to these types of levels. These levels are going to pay you the big bucks, or have the potential to pay you the big bucks, especially if they start to gain momentum in the opposite direction. So strong support held. The market moved higher. The other level that is of importance here off this chart is the move back above the 100-day moving average, and this is more immediate for this currency pair. Why? Because just yesterday the market was above that 100-day moving average, and we tried. It was like the little engine that could, to stay above the 100-day moving average, but it couldn't. And that led to the sharp move to the downside, and then the close right here, and then further selling pressure here from a technical perspective, okay? So now that we're back above the 100-day moving average, what does that say? That says we have to stay above that level. We don't want a repeat of what happened here, all right? We want the market to continue in its upward bias right here for the bulls and continue its move higher from this level. We don't want the price to move below the 100-day moving average if you're long, and you should be long because the bias is positive above the 200-day moving average, above the 100-hour moving average, above the 100-day moving average. All these things are positive. We're also above the 50% retracement. So from a risk standpoint, you don't want to see the price start to move back below the 100-day moving average. That's our close risk level. If you want to take it a little bit further, this level right here, this swing area right around the 0.62 level, is going to be a key level. Just looking at the picture that we have right here, it was when we fell back below it, we used that level as resistance here and here. But if you go back in time, we had a low right here. And then if we go back even further in time, you can see we had lows here. It was a high right here. It was lows right here, and a high right there. So all these levels right here around the 0.6200 level is what makes this level a key level. And indeed, in trading here today, when the market did rebound higher, we did stay below that level and force its way down to the 100-hour moving average, 200-day moving average. So stay above the 100-day moving average, and the buyers remain in full control. Move below that level, and if you want to keep the bias to the upside ahead of the 0.62 level, that's okay. But if we start to move back below the 62 level, then there'd probably be a little bit more of a problematic. We could see further downward momentum to the downside here, maybe even revisit the 100-hour moving average. You never know. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.